Good morning, everyone. So you remember last class we talked about the simple liquidation method, right? So we completed simple liquidation method. Now we are going to move on another method called installment method. Now there are some disadvantages. For the simple liquidation method. So as there are some wrong with the simple liquidation method or disadvantages with the simple liquidation method, we are going to introduce a new method called the installment method. And the installment method is quite acceptable because this method is very conservative method. And in accounting, actually, we always looking for the conservative method, right? So installment method is quite conservative, and there are some limitations or disadvantages of simple liquidation. What are the limitations? You can see that the first one is the fire sale. First one is the fire sale. What is the meaning of fire sale? What is the meaning of the fire sale? That means today, for example, today is the liquidation day. Company decided not to continue the business. And as they are going not to continue the business, so they sell their assets immediately, right? You decided not to continue your business. So you have some assets and you have to pay your liabilities, right? So what are the disadvantages here? So you sell your asset very quickly and you try to receive some money from the market. But when you sell something very quickly, you know that means you have to sell it with a discount. Maybe if people knows that you are going to liquidate your partnership business, maybe they are not going to give you more money, right? So if you sell very fastly, okay, then you have a chance to have some loss. We have asset, we try to sell our asset with gain, right? But if you sell it very quickly, we have a chance to get some loss. So this is one limitations, and this limitation is really unrealistic. If out of loss, it's not a realistic measure. So this is these are the disadvantages. So this is a simple liquidation method is unrealistic because we have some fire sale with loss. Now, what about the realistic methods? So here, the realistic issue is you sell your assets over time. Sell your assets over time. For example, you have a building, okay, you sell it today, maybe a few days later you sell your land, and another days you can sell your equipment, okay, something like this. So whenever you have a very good customer, whenever market price is higher, then you can decide to sell your land, right? You can decide to sell your building, something like this. So sell assets over time, not sell all the assets quickly, okay? According to simple method, you have to sell all of your assets quickly and today, for example. But according to the installment method, they said that no need to sell asset very quickly. You can sell assets over time. So this is the more realistic. This is the more realistic method that you can sell your asset over time. You can sell your asset over time. Now you can see that partners wants back their money. So in this installment method, you should understand that whenever business sell asset, because business is not selling asset today or quickly, everything, right? Selling over time. So whenever business sell asset over time, so partners should receive their money. Do you understand? So this is the responsibility of the business, that whenever business sell asset, from to the partners and give them money back. Because partner, the asset is going to sell. Whenever you sell your asset, you should inform the partners that this is your money, you can the money. Now, when partners are going to pay it, a special care must be taken. Okay, a special care must be taken not to give assets to partners who might owe money later. Do you understand? For example, you sell $10,000, but the partners will receive $40,000. Now, how to distribute this $10,000? This $10,000 can be distributed who has the ability to survive. Last class, I explained who has the ability to survive and who don't have the ability to survive, right? So whenever you sell your asset, you must pay this money to the partners, but this cash may not enough to pay all the money to the partners. So if we don't have enough money to pay the partners, then we have to find out who has the surviving ability and who don't have the surviving ability. If I don't have the surviving ability, the partnership business is not going to give money today. Maybe partnership will give this money to the partner who has the surviving ability. So a special care must be taken. This is very, very important for installment method. A special care must be taken not to give asset to partners, okay, who might owe money later. That means who has the capital deficiency, for example. If you have capital deficiency, it means that you don't have the ability to survive, right? So if I have the capital deficiency, you don't need to give me money, but the partners who do not have the capital deficiency, but these partners can receive some money. So this is a very, very important point when we are going to talk about the installment method. Now I said that installment method is very, very conservative method. This is the most conservative method. This is the most conservative method. And what is the first conservative here? Loan from partners are added to their capital balances. Can you remember last class? This is also common with the simple method. So we offset loan with partners. Okay. For example, business receives some loan from the partner. Okay. If business receive any loan from partner, they can offset this loan with the partner's capital. Right. So this is common for the simple liquidation method. We learned this, that if we have any loan from partners, we can offset this loan with the partner's capital, with partner's capital. So this is the first assumption. This is the first assumption. So you should remember this. The second assumption. So try to understand. This is some assumption. Okay, this is some assumption when we solve the question. Remaining non-cash assets are sold at zero. Remaining non-cash sale, okay, of assets are assumed to have a zero amount. What is the meaning? The meaning is, for example, I sell land today $10,000. Okay, and I have another building. I will sell it in future. So today I have to assume that the building I am going to sell in future, it will have a zero amount. That means totally no income, totally loss. So this is the assumption. So I can write here, for example, you can see that I have a land at this moment. The value is $50,000. And I have a building and the value is maybe $20,000. So try to understand carefully. This is very, very important concept. This is very, very important concept for simple installment liquidation. So these are my non-cash assets, right? These are my non-cash assets. So today I sell land and received $60,000. So I have a gain here, right? I have a gain. The book value of the land is $50,000. I sell this land and receive $60,000 from market. So I have a gain, right? I have a gain. Now this gain is going to distribute to the partner's capital. You know that. Now I have remaining asset. Which one is remaining? Building is the remaining, right? And the value of the building is $20,000. So as we are very conservative, so we assume that we assume that the market price, we assume that market price or fair market value of this building will be 0 in future. Okay, so this is the remaining asset. I sell land today, and the remaining asset is the building, right? And remaining asset in the building, and we assume that this is the assumption. We assume that the fair market value of this building will have $0 in the future. So what is the loss here? If fair market value is $0, that means our loss is $20,000. Loss is $20,000. So this loss we have to assume from the very beginning. This loss we have to assume very beginning, and this loss $20,000 will be allocated to the partner's capital. So this is something assumption you have to think from the very beginning. So here we sell our land today, receive $60,000, and our gain is $10,000 here. This gain will be allocated to the partner's capital. So today I sell asset, we have a gain will be allocated to the partner's capital, but remaining asset, building is a remaining asset. Remaining assets like building, book value is $20,000, but today we have to assume that we are not going to sell this asset with our expected money. It should be 0. That means $20,000 is the loss, and this loss will be allocated to the partner's capital. So why we do this? To check who will have the surviving who will have the surviving ability? Who will have the surviving ability? Because look at here, this $10,000, is the gain, and this $20,000 is the loss. Okay, so we are going to allocate this loss to the partner's capital to see who will have the surviving ability, or who is the most, or and we are going to figure out who is the forced partner. That means who don't have the ability to survive in future. So this is second assumption. The third assumption is partners are personally insolvent. So from the very beginning, we'll assume that partners are personally insolvent. What is the meaning? Meaning is partners cannot came up with any money. That means here we assume that partners personal liability is greater than can you remember last class I also discussed what is the meaning of insolvent partner? Insolvent partner means partners don't have any personal asset, okay, that they bring to the capital if they have capital deficiency. So from the very beginning, because we are following the conservative method, so from the very beginning we have these three assumptions. First, if there is any loan from partners, we are going to offset this loan with partners capital. Second, if we have any remaining assets, we will assume that this asset cannot be sold. Okay, this asset cannot be sold. If this asset cannot be sold, it means that it is the loss, right? And if it is a loss, we have to allocate this loss to the partners to see who has the ability to survive. After that, we will assume that no partners has the ability to bring any personal cash from personal cash to the business. So do you have any question? Because we are going to see the safe payment approach. This is important. Safe payment means, I told you that if partners business have any cash, the partnership business is going to pay this money to the partners, right? Here you can see that I told you that we are going to sell asset over time. If you sell asset over time, you will receive cash, right? You will receive cash. Now this cash is going to distribute to whom? Cash is going to distribute to the partners. So when this cash is going to distribute to the partners, we have to have very special care for safe payment. Who is going to receive this money? Okay, so today you are 3 partners and partnership business as sale asset $10,000. Now who is going to receive this money? Maybe all 3, maybe not all. Okay, maybe not all. It depends on what is your capital balance. Okay, whether you are surviving or you are not surviving. Anyway, let's see if we solve one question, then we can easily understand everything. So it is important to solve the question first. So let me explain question 3 first, because it is quite short than question 1. So let me explain exercise 3. So you already have the blank sheet, so we can solve this question together. We can solve this question together. Please read the question first. So here you can see that the following balance sheet of the BDO partners. So they are the 3 partners. B, this is B capital, this is D capital, and this is O capital. So their 45,000, 27,000, 50,000 partnership capital given, liabilities given $18,000. So this partnership has liabilities and these are the capital. Now they have some cash and non-cash items. So this is the cash. So this is the cash, $10,000, and they have some non-cash. Accounts receivable non-cash, inventory non-cash, equipment non-cash, and this is the amount. And total is 140, 140. Now, based on this information, you can, if you compare this here, if you compare asset and liability, what is the meaning here? Business cash at this moment $10,000, but liabilities is $18,000. Liabilities $18,000. So business do not have enough cash. Business do not have enough cash to pay the liabilities, right? Business do not have enough cash to pay the liabilities. So what should we do? We should sell some asset over time here. We should sell our assets. So if it is simple liquidation, we are going to sell all the assets together today, right? If it is a simple liquidation method, we are going to sell all of our non-cash assets today. But we are going to talk about the installment liquidation method. And this is the most conservative and the most realistic method. So we are going to sell this kind of asset over time, right? We are going to sell asset over time. So whenever we will sell asset over time, first we have to pay the liabilities, right? After paying the liabilities, if we have remaining cash, this remaining cash is going to distribute to the partners, not all. Maybe we have to check. We have to check who has the ability to survive. He or she will receive this cash. Let's see to solve this question. And 442 is the ratio. This is their income ratio. First, assume that 70% of the receivables are collected. 70% of the receivables are collected. So we have, if we do some calculation, we have $40,000. We have $40,000 is the receivables, right? And from here, not collected all, only 70%. Only 70% collected. That means that $28,000. $28,000 collected. $28,000 collected. If $28,000 collected, what is the remaining? From $40,000 is the total amount, right? We only collect $28,000. We only collect $28,000, so remaining not yet collected, right? Remaining not yet collected. So this is related with cash. That means we collect cash. Now, before we had $10,000, right? Before we had $10,000 on hand. Now $28,000 is going to add, right? $28,000 is going to add. Now we can pay the liability, right? We can pay the liability. Now another important point here, they also sell some inventory. So inventory with a book value. Inventory book value is $15,000. Okay, total inventory is $30,000. They sell how much? They sell they sell $15,000. But how much cash they receive? How much cash they receive? $10,000 cash receipt. It means that we have a gain or loss here. We have any gain or loss? Loss, right? We have a loss. Very good. We have a loss. How much? $5,000 loss. We have $5,000 loss. So, and we know that if we have any loss, we are going to allocate this loss to the partners. But how much cash we receive actually? We receive cash $10,000. We receive cash this $10,000. Now look at here, we receive cash $10,000. We receive cash $28,000. Okay, and we also have a cash balance. We also have a cash balance $10,000. Now we have many cash, right? Now from this cash we have to pay our liabilities, right? We have to pay our liabilities. After paying liabilities, we are going to check the remaining money is going to pay to which partner. Do you understand? So let's solve this question together with me. So you already have the blank sheet, and do it with me so that you can easily understand everything quickly. So this is the accounts balances, beginning balances, or we can say here beginning balances. Beginning balances, $10,000, cash, non-cash, 130. If we add these three together, 40, 30, 60, right? It total is 130. Then we have liabilities, $18,000. Then we have B capital 45. Then D capital 27, and O capital is $50,000. And this is their profit and loss sharing ratio. Now what we did here, we sell inventory. Sell of inventory. Okay, we sell inventory. We sell inventory and we collect cash. We collect cash. So we sell inventory and we collect cash from accounts receivable. So we sell inventory. We know how much inventory sell and how much cash we receive anyway. We collect cash from accounts receivable, and because we are going to use one row for several purposes, and allocate loss. Do you understand? So this is the first transaction, right? This is number one. This is number one. Why I put number one? To show you some journal entry. I don't know whether I need to show you the journal entry or not, because I already explained the journal entry later on. Anyway, maybe I'm not going to show you the journal entries. So how much cash we receive now? Look at here. We sell. We receive cash $28,000 from accounts receivable, and we receive cash $10,000 from inventory, right? So $38,000. $38,000 cash we received, right? Now, how much sale we sacrifice? How much asset we sacrifice? Can you calculate this? how much non-cash asset we sacrifice. So we received $38,000, right, from non-cash asset, but how much asset actually we sacrifice? How much? So first we sacrifice book value. Look at here. We sacrifice book value $15,000, right? We sacrifice. Okay, I can write here first. We sacrifice $15,000 book value, right? We sacrifice this, and we sacrifice from here. From here, we already sacrifice 70%, right? $28,000. So this is our sacrifice. Look at here. We sacrifice $28,000 accounts receivable decrease, right? Accounts receivable decrease, and we sacrifice our inventory $15,000. So what is the total amount here? 43, right? 43. And the 5,000 is the difference, right? 5,000 is the difference. This difference is the loss. This difference is the loss. Yes. So $43,000. $43,000 non-cash asset decrease, and it converted into cash $38,000, and 5,000 is the loss, and this loss is going to allocate 40, 40, 20 to the partner's capital. So loss is the bad news. So this is going to decrease 2,000. I hope you know how to calculate this. This is 2,000, and this is 1,000 because 20%. So loss is allocating to the partner's capital. This is the asset sacrifice, and this is the cash we received. Now, what is the balance here? Now, balance here is $48,000 cash. Sorry. So our balance is $48,000 cash now available. Our asset decreased to $87,000. We have liabilities $18,000. We have breach capital $43,000. This is $25,000, and this is $49,000. This is the balance now. Now, if we compare these two, if we compare our cash and liability, okay, if we compare our cash and liability, we see that now we have enough cash to pay the liability. We have enough cash to pay the liability, right? Now we are going to pay the liability first. Payment to creditors or payments to liability. Payments to liability. So we are going to pay them $18,000. We are going to pay them $18,000. Or liability decrease $18,000. Or liability decrease $18,000. So this is the payment paid to the made to the partner's liability, right? Now, what is the balance we have available at this moment? Balance we have $30,000. $30,000. Now our non-cash asset, remaining non-cash asset, right? Try to understand. $87,000 is the remaining non-cash asset. And we have zero here. We have zero. Then we have capital balance 43, 25, and $49,000. Do you understand? We paid all liabilities. This is closed. Liabilities account closed, right? After closing the liabilities, now we have $30,000. We have $30,000 cash, right? These $30,000 cash are available, and these are the capital balances. These are the capital balances of the partners. Try to understand. According to this schedule, both partners are the surviving partners, right? All of them, their capital balance is positive. Do you understand? $43,000 credit balance means positive, right? $25,000 positive, $49,000 positive. But how much cash we have actually to pay? How much cash ability? We have $30,000, but their capital is higher, right? So this $30,000 is not enough. This $30,000 is not enough to pay them all. Now, who is going to receive this $30,000? B, D, or S? Okay, because if we go to our assumption, if you remember our assumption said that a special care must be taken. Okay, a special care must be taken not to give assets. Asset means cash, right? Not to give cash to partners who might owe money later. That means maybe in future someone is not going to survive. At this moment, all people have the surviving ability, right? All people will have the surviving ability according to this stage. But we have to check what may happen in future, who may not have the ability to survive. If someone do not have the ability to survive, we are not going to pay this money, right? This is one assumption. Another assumption, look, we already sell some of our asset, right? Do you understand this part? Some asset already sell, and look at here, we are not going to sell all asset today. We are going to sell asset over time. Right? So we already sell some of our asset. According to our question, we already sell some of our asset, right? After selling some of our asset, we allocate gain or loss. Now the remaining assets, okay, remaining assets should be assumed that we will not have the ability to sell this asset, and we will have a zero balance, and we will have the loss totally. Do you understand? So remaining asset, I told you here before, remaining asset is building, for example, $20,000. We assume that future market value will be zero. If future market value will be zero, then totally $20,000 is our loss, right? Totally, and this is future loss, but we don't know. We just assume it. It may not happen in future. Okay, it may not happen in future, but according to the conservative method, we should assume this loss from the very beginning. And this loss is going to allocate the partners to see who has the surviving ability or not. Now, according to this question, we already sell $43,000 asset. Okay, we already sell $43,000 asset, and we have remaining asset. Okay, our remaining asset is how much? Our remaining asset is $87,000, right? We assume that it will be zero. That means if we sell it, okay, if we sell it, we do not have any gain, any loss. Do you understand? So remaining asset $47,000. Now we are going to allocate this $47,000 as a loss. Okay. Now we are going to allocate this $47,000 as a loss. 47 or 48? 47. Okay. $47,000 as a loss. Okay. And we are going to allocate here to see who has the surviving ability. So to do so, we have to make some workings. It is called a schedule to compute the safe payment. Okay, a schedule to compute the safe payment. So we are not going to do here, but we are going to do it as a workings. Now at this moment, you can see that at this moment, this is their capital balances. At this moment, this is their capital balances. So capital balances before safe payment. So capital balances before safe payment. This is the capital balances before safe payment, right? Here, this one. I just copy and paste. Now we are going to assume that this totally $87,000 is the loss. This is the assumption, right? That assumption that the remaining asset may not be sold out, okay, and we will have the completely loss. Now we are going to allocate loss. Allocate of potential loss. Do you understand what is the meaning of potential? That means expected, right? Maybe. Potential loss And how much is the potential loss? We assume that the entire amount, okay, remaining entire amount is the potential loss. Remaining entire amount is the potential loss, right? Potential loss, and this loss is going to allocate 40, 40, and 20, right? We assume that this 87,000 is the potential loss, okay, just assumption, okay, and we are going to allocate this loss here. And if you are going to allocate this loss here, it is 38,000, 34,800. Same 34,800 here. And also we'll have 17,400. Okay, so after absorbing loss, what is the balance? The balance is 8,200. 8,200 is the brick, right? 8,200. Then Davis is not have a good news. And Olson is 31,600. So we find that in future, Davis may not the ability to survive, right? Davis may not the ability to survive. Now, who has the surviving ability? Olson has the surviving ability, and the Briggs has the surviving ability. But if we add these two money together, look at here. If we add these two money together, it is over $30,000, because we have how much cash we have remaining? We have remaining cash only $30,000, right? We have only remaining cash $30,000, and we find that Davis is not going to receive any money today, right? Any money today. Brick will receive the money, and Olson will receive the money. But their balance is over $30,000, right? Their balance is over $30,000. So what should we do? We are going to absorb. We are going to absorb the D capital to Brick and Olson. That means we are going to allocate this loss as our loss. Can you remember? In the previously we learned that. So 9800, we are going to make him 0. Okay, we are going to make him 0, and we are going to allocate this loss. We are going to allocate this loss 40% and 20%, right? 40% and 20%. Now, what is the case? It is 6533. 6533 and 3267. 3267. So we absorb this loss. We absorb this loss. Now, what is the balance? Look at here. The balance is 1667, 1667, and here is 28333. Now again compare this to money. Now again compare this to money, and it is $30,000, right? It is $30,000. So Davis is not going to receive any money today. Look at it, not today, only today. He is not going to receive this money, right? Maybe he will receive some money in future. But we have available balance here $30,000. We have available balance here $30,000. So from here, Davis is not going to receive any money. Clear? From this $30,000, Davis is not going to receive any money because he completely do not have the surviving ability. Now we prepare this schedule. We find that Olson is going to receive $28,333 and Briggs is going to receive $167. So if you merge here, it is actually $30,000. $30,000. Clear? So this is the $30,000 is the money today we have available, and this money we are going to pay some to Briggs and some to Olson. Okay, and today Davis is not going to receive any money. Now we know this information. This money is going to paid. He is going to receive this money. Okay, if you receive this money, your capital will decrease, right? if you receive this money, your capital will decrease. Your capital will decrease because you already received this money. You already received this money. He is going to receive money only, no money, right? No money is going to receive by him. And business pay cash $30,000. Yes. So this is called payment to partners. Payment to partners. $30,000. Now what is the balance here? Zero. $87,000. Now new capital balance. Then $25,000. And Olson is 2667. Now this is the new balance after paying $30,000. After paying $30,000, this is the new balances, right? Now I make this question easy. I make this question easy because this is the first example I am going to show you. Now assume that the remaining non-cash asset, remaining all non-cash assets. And what are the remaining all non-cash assets? According to this question is $87,000. $87,000. So now assume that remaining all non-cash asset $87,000 are sold at $57,000, right? $57,000. It means that we have some loss. We have some loss, right? We have some loss, and this loss is going to allocate to the partners, right? This loss is going to allocate to the partners. Now you can say that sell non-cash assets and allocate loss to the partners. So we sell all of our non-cash asset, and how much cash we receive? We receive cash $57,000, right? We receive cash $57,000. So this is $57,000. And according to this question, this is sold everything, right? Everything sold. So we use two installment actually. We use two installment. First installment we sell, look at here. First installment we sell $43,000, right? And second installment we sell $87,000. That means total $130,000 sell. Clear? So this question I only used two installment. Maybe I'm going to show you another question, maybe 3 installment or 4 installment, something like this. So I make it easy. I just make it 2 installments. So $87,000 is sell, right? That means we sell all of our asset. We don't have any remaining asset actually. We don't have any remaining asset. Now we have a loss, and this loss is going to allocate to the partners according to 40, 40, 20. And what are the loss? You can see here. The loss is $12,000. So $50,000 is the loss, right? $12,000 loss, and 6. Yes, $30,000 is the loss, right? $30,000 is the loss, and we allocate this loss. So after allocating the loss, what is the balance? Our cash is $57,000. Cash is $57,000. Asset becomes 0. Liability is already 0 before. Liability already 0. So what is their balance now? The balance is now 29,333. 29,333. Then $13,000 and 14,667. So after allocating the loss, this is the things. We have available cash. Look at here. We have available cash $15,000, $57,000, and this is the money we have to pay to the capital partners, right? Now, if you add this three, what is the total amount? 14,667, 13,000, 29,333. If you add all this money together, what is the amount? 57, right? And business also have cash 57. So do we need to prepare any safe payment schedule? Do we need to prepare this schedule again? Of course not, right? Why not? Because now we have available cash $50,000 and we have the available money to pay them the capital, right? If this capital is higher, okay, if capital is higher and this payment is lower, and if we have some remaining asset, okay, then we are going to pay this schedule. So now we don't need to pay any schedule, we just pay the money because we have the available money. Payment to partners. So $57,000 we are going to pay. So it is minus. And this money is enough to pay this money, to pay their capital. So after paying this capital, what is the balance here? 0. You can say that all 0. All 0. And this is the ending balances. Ending balances. So partnership is closed, right? Now don't worry, maybe you understand 80% or 60%. If we solve another question, we can easily understand. So we can do together question 1. We can do together question 1. I think we can do it very quickly now. So you see here, Nelson, Parker, and Rice are the partners who shared their profit 433. So you understand this. Parker decided that would not be more profitable for him, and he want to do a part. That means Parker want to do a business separately. He said that I want to be only one owner. Okay, so I am not going to continue with you. And Nelson and Rice mutually agrees that their association should be dissolved. So Parker is going to leave. Okay, Parker is going to leave, and other two people decided, okay, not to continue the business, make it liquid. Okay, make it close. And this is the balance sheet before the liquidation. As liability is $20,000, and this is their capital. No problem, right? This is the asset. We have two assets. One is cash, another is non-cash. So other assets means non-cash actually. So cash $5,000, non-cash $60,000, total $65,000. And I told you that according to the installment method, sell assets over time, right? Sell asset over time. So the example I already explained, we had 2 installments to sell our asset, right? We had 2 installments to sell our asset. And according to this new question, we have 5 installments. So we are not going to sell our asset all together, right? We are not going to sell asset all together. We are going to sell asset over time. in the first stage, you can see that in the first stage, we sell, this is the book value. We sell $12,000 of our non-cash asset and we receive cash $16,000, right? We are going to compare this the market price. Fair market value. This is the fair market value. This is the fair market value. And it is related with cash. We receive cash. Right. So book value $12,000. So first we sell $12,000. We receive cash $16,000. So we have a good news or bad news. This $4,000 is good news or bad news? Good news, gain. And this gain is going to allocate to the partners. Partners' capital will increase, right? What about the second installment? Our book value is $10,000, but we receive cash from market $12,000. Again, $2,000 is the good news, right? $2,000 is the good news, gain. Then in the third stage, we sell $20,000 asset, but we receive cash $10,000. So of course it is a bad news. It is a loss. And this is the last installment, right? The last stage, we sell our $18,000 of book value asset, but we receive $2,000, and again $16,000 is the loss, right? And if we add all together here, it is how much? It is, you can see the 60,000. It is $60,000. So total asset, our total asset is $60,000 non-cash asset, right? But we are not going to sell them all together. We are not going to sell them all together. We are going to sell them by installment. Okay. And this is the cash receipt. And sometimes we have gain, sometimes we have loss. Okay. Now we are going to allocate this gain or loss. And after allocating the gain or loss, if we have any remaining cash, okay, this remaining cash we have to pay them. Okay. And but not all the partners. The question said that whenever you are going to pay cash, don't pay them immediately to all partners, because you have to have a special care those who have the surviving ability, right? Those who will have the surviving ability. Now let's solve the question with me together. These are the balances. Copy and paste from the question. Now we sell. It is one, right? You can see that it is one. We sell $12,000 of asset, right? We sell $12,000 of asset. So this is $12,000 asset decrease. $12,000 asset decrease, right? So why we sell our asset? Look at here. We don't have enough cash to pay the liability. Liability $20,000, but our cash is $5,000, so we don't have the ability to pay the liability. So we must sell some asset first, right? So we sell $12,000 of asset, but how much cash we receive? We receive cash $16,000. We receive cash $16,000. So sell non-cash assets. Sell non-cash assets. And according to this question, we have a gain. And allocate gain to partners. Right? And how much gain is $4,000. So $4,000 is going to increase their capital. And it is 433. So 1,600. Then 1,200, right? 1,200. So we have a gain and we allocate gain to the partners. Now what is the balance here? Cash became $21,000. Cash became $21,000. So our remaining non-cash asset, is $48,000. Remaining on non-cash assets. So this is our liabilities. Our liability now $20,000. Then now N capital is increasing, right? Because if you have gain, your capital will increase. So it is 21,600. This is 13,200. And also this is 14,200. Their capital increase. Now compare cash. Now compare cash and the liabilities. Compare these two. Now we have enough cash to pay the liability. So first we have to pay the liability. Now payment to creditors. Payment to liabilities. So how much cash we are going to pay them? We are going to pay them $20,000. Our liability decreased $20,000. And our cash also decreased $20,000. Our cash also decreased $20,000. After that, we have $1,000. $1,000 available cash. We have $48,000. We have $48,000 non-cash asset. We don't have any liability. We close them. Now this is the capital balance for N. This is the capital balance for P. Okay, and this is the capital balance for Rise. Clear? Now you can see that we have $1,000 cash available, and our capital balance is too much, right? Capital balance is too much, so $1,000 is not enough money to pay the liability, to pay the capital. Now what we should do? We should prepare a schedule. Who is going to receive this $1,000? Who is going to receive this $1,000? We are going to make a schedule, right? Now, when we prepare the schedule, we will assume that this remaining non-cash asset, is totally lost, right? If this remaining, so let me the capital balance before schedule. So you put this balance here. Okay, so this is the capital balances before SAVE payment. Before SAVE payment. Now we are going to allocate loss. We are going to allocate loss. I think allocate, we can write allocate potential loss. What is our potential loss? Our potential loss is $48,000, right? This is the potential loss, because we assume that this money is totally lost. We assume that this is our potential loss. Okay, and this loss is going to allocate. This loss is going to allocate based on 40. Okay, 40, 30, and 30. So this loss is going to allocate. So the loss will decrease their capital. It is 19,200. This is 14,400. 14,400. So this loss we are going to allocate here 14,400. After allocating the loss, what is the remaining balance? 2,400. Then it is and this is 200, right? This is 200. So we can see that only Nelson has the surviving ability, right? Only Nelson has the surviving ability, but P and R do not have the surviving ability. So P and R is not going to receive any money. Now Nelson is going to receive money, right? But the problem is, what is the remaining cash available actually? 1,000. So Nelson is not going to receive $1,000, right? Because remaining cash is only 1,000. So Nelson is going to absorb this loss. Okay, Nelson is going to absorb this loss. So 200,000 loss is going to absorb by Nelson. Parker 1, and it is totally 1400. So this loss is going to absorbed by Nelson, and they become zero. Look at it, they become zero. They are not going to receive any money, and Nelson balance is now how much? $1,000, right? Now the remaining cash is $1,000, and after absorbing the loss, Nelson capital also $1,000. So Nelson is going to receive this money. Clear? Now we can see that here payment to partners. Payment to partners, schedule 1. So we are going to pay this money according to the schedule 1. According to schedule 1, right? We are going to pay this money according to schedule 1. So $1,000 we are going to pay this money. $1,000 we are going to pay this money. Now this money is going to receive by whom? This money is going to receive by Nelson. Okay. Now what is the balance here? Now balance 0, cash, $48,000 other asset. It is 0, and this is now 20,600, right? 20,600. This is 13,200. 14,200. Clear, right? Now look at a schedule, second stage. Now company sell $10,000 asset, right? And receive $12,000 cash. Now from here, this is the non-cash asset remaining. From here we sell how much? From here our $10,000 asset decrease. Our $10,000 asset decrease. $10,000 asset decrease, and we receive how much cash? We received $12,000, right? So sell non-cash asset, and allocate gain or loss. We have gain or loss here. We have gain, right? Allocate gain. Who is going to receive this gain? 3 partners, and it is 800, 600, and 600. 800, 600, 600. So what is the balance now? Cash is now $12,000, and this is $38,000, and this is 0, and this is 21,400. 21,400, right? Am I right? Then 13,800. 13,800 and 14,800. This is the remaining balance, right? Now look at here. We already pay the liability, right? We already pay the liability. So we don't need to pay the liability again. But we have remaining cash, how much? We have remaining cash $12,000, right? Now this $12,000, who is going to receive this money? These people, right? These people are going to receive this money. But do they have enough money? No, right? They don't have enough money. So what should we do? We should prepare a schedule again. We have to prepare a schedule again. So this is the balance before. This is the capital balance before payment. So this is the capital balance before payment. Now, how much loss we have to assume from here? What is the potential loss from this column, from this row? Which amount is the potential future loss? $38,000, right? $38,000 is the potential future loss. So we are going to allocate our potential loss. We are going to allocate our potential loss. And potential loss is $38,000. $38,000, it is 433. Now, the amount is 15,200. Amount is 15,200. Then the amount is 11,400. Okay, 11,400 and 11,400. After that, what is their balance? The balance is 6,200, 2,400, and 3,400. Now, if we add this money together, what is the money here? What is the money here? If we add this together, because both has a surviving ability, right? Both have the surviving ability. So if we add together, what is the amount? This is $12,000, right? So how much remaining cash we have? We also have remaining cash $12,000, right? So they have the ability to survive, and they are going to receive this money. They are going to receive this money, right? So this $12,000 they are going to receive here. And if they receive money, their capital is going to decrease if they receive money. And we pay $12,000. We pay $12,000. We pay $12,000. So what is the balance now? So this is payment. This is payment to partners. Payment to partners according to which schedule? According to schedule 2, right? We prepare schedule 2 and we make the plan. Clear? Now the balance is, look at here, balance is 0. And here balance is $38,000. Then 0. Now their balance is now, their balance is now 15,200. 15,200, 11,400, and 11,400. 11,400. Now, according to stage 3, company sell $20,000 asset. Company sell $20,000 asset. This is the loss. Sorry, this is the book value they sell. And how much cash they receive? They receive cash $10,000. So this is called sell non-cash asset and allocate loss to partners. Allocate loss. Right? We sell non-cash asset $20,000 but receive cash only $10,000. So it is our loss. We are going to allocate this loss 4,000. 4,000, then 3,000, 3,000. This is the loss going to allocate. After allocating the loss, our cash is $10,000. This is $28,000. 0. What is the balance? The balance is 11,200. 11,200, then 8,400, 8,400, and 8,400. Now again, look at here. We have $10,000 cash, right? We have $10,000 cash, but their capital balance is higher. If their capital balance is higher, we have to prepare another schedule. Who is going to receive this 10,000? Who is going to receive the 10,000 to make another schedule, right? Who is surviving? So capital balances before that, right? Then we are going to allocate future loss. What is our future potential loss now? Our potential loss is now $28,000, right? We assume that this may not be sell. Okay, so 28. So this 28 is going to allocate something like 15,200. Sorry, 7,200. 7,200. This is the loss. Yes. 18. Okay, 18. Yes, 18. 18. Thank you. 18. So this is something like this, 5400, 5400 and 5400. Okay, thank you very much. 18,000 because 38 and 20. Yes. 18,000. Now we find that after absorbing the loss, what is their balance? The balance is 4,000, then 3,000 and 3,000. And if we add all these three together, what is the amount? The amount is also $10,000. Look at here. $10,000, right? That means all are surviving. So this $10,000 is going to receive by them, something like this. This $10,000 is going to receive by them. And $10,000 is going to decrease. $10,000 is going to decrease. So payment to partners. Schedule 3. What is the balance? 0. We have 18,000. So when we make payment, their capital is going to decrease because we are going to make payment, right? We pay them, so their capital will decrease. So what is the balance now after paying them? It is 7,200. 7,200, then 5400, right? 5400 and 5400. Now we are last stage. Remaining $18,000, right? We sell all of our remaining asset, right? So we don't have any future potential loss. Do you understand? We don't have any future potential loss because we are going to sell our all remaining asset. It becomes 0, right? It becomes 0. How much cash we receive? We receive $2,000 cash. $2,000 cash. So sell non-cash assets and allocate loss to the partners. Sell non-cash assets and allocate loss to the partners. Sell non-cash assets, so our asset decrease. We receive cash. And how to allocate this loss? Am I right? Yes. So loss is going to allocate 6400, 6400, then 8400. Right, this is the loss. We are going to allocate them. After paying loss, what is our balance? Our cash balance is $2,000 because we are going to allocate this loss. This is 0. This is already 0. And what is the balance? Balance is 800. Balance is 600. And balance is 600. Now we no need to prepare any schedule. Why? Because our remaining cash is $2,000, right? And their capital balance is 800, 600, and 600, also $2,000. No need to make any schedule. No need to make any schedule. So payment to partners. We pay them, their capital decrease. and become 0, 0. Do you understand? So try to practice at home. Okay, try to practice at home. So thank you very much.